Hey, this is the Profit with Nick Black. It's time to chit chat. You know nothing about blockchain. We here to fix that. You want the news on the new stocks? This where you get that. So go and grab you a nice chair. It's time to sit back and talk to Profit. Hey, hey, you talking to the Profit? Hey, hey. We talking condos and nice clothes and driving Lambos. I remember them night codes, we couldn't stand those. We tried to drive on them high roads, but had to stay low. Now there's solutions to hard bills we couldn't pay for. I talked to Profit to get some profit, we couldn't change the top. If it's a stock and I need a cop it, I wait for him to drop it. Ain't no option, let's get it poppin', we chillin' in the trap. I need some crypto, put it in my pocket, by any means I rock. This is the Profit with Nick Black, it's time to chit chat. You know nothing about blockchain, we here to fix that. You want the news on them new stocks, this where you get that. So go and grab you a nice chair. It's time to sit back and talk to Profit. Hey, hey, you talking to the Profit. Hey, hey, you talking to the Profit.
Let me tell you what I don't do. I'll tell you what I don't do. I don't do meetups. It's the absolute biggest dumpster fire on the planet. But I got conned into one. Oh, yes. I got conned into one yesterday. I actually met some cool people. I met a couple of cool people, but for the most part, I don't do meetups. You know why? Because it's a dumpster fire. Because at a meetup, everybody wants to let everyone know how smart they are. And then people regress and panic and say all sorts. So I don't do meetups. So if we're being honest, God, it's a mess. So, but maybe I should start doing meetups because I learn what the people that think that they know what is going on. I learn what they think they know. And then I also learn what they don't know. And it's a lot. People are so clueless. And this is people that are in the business, you guys. And that's problematic. So, yeesh. If you think you're just getting, maybe this is more of a testament to always be a student, right? Like always be a student. I think that's important. I mean, I'm always a student, especially anytime I listen to Jeff Snyder, Mike Green, you know, these kind of Robert Hurst, like these guys, I'm a student. You have to be a student, especially to the macro, because the macro is always changing. And you need, so that's your framework, right? But these crypto meetups, no way. So let me tell you how I got conned into it. I got conned into it because my buddy's like, hey, we're going to talk to these guys about tokenizing loan. I thought I was going to meet some people from a lending platform. And as you guys know, maybe I've told you, maybe I haven't. I have talked to the people at Salt. Was not super impressed. I've talked to the people at Celsius. Not super impressed. I've not talked to anybody at Nexo, but I am impressed with Nexo. Abra, I met someone from Abra. I didn't really get a good sense. I can't say either way. I don't know what I could never ferret out their understanding of the market. And when we started digging deep, this is another thing about meetups. When you start digging deep, people start disappearing. Meaning there was a long table and there was one guy that I was talking to. Well, there was a couple of guys that I was talking to, really cool guys. And first, everybody was super nice. But I was talking to, it was me and Dave and a few guys. This guy, Stuart, real cool guy. And then there was some other guys. And then the other guys started working their way to the other side of the table. It's like, uh-oh, we're talking about real stuff. I'm out. And then there was one side of the table that was lopsided. And if you had measured the crypto IQ at our side of the table and the crypto IQ at the other side of the table, that boat would have sank. So it is what it is. I think that's a good question. Mike Green. I think Mike Green is two things. He is incredibly smart and he's plagued a little bit by intelligence. He's refusing to accept. He's succumbed to the same biases that he's kind of describing for the greater markets. This chase over growth rather than value. The lower IQ market, the passive indexation effect, those same things that he's seeing where he's telling fund managers, hey, you have to realize this is the new normal. Things have changed and they're not likely to ever go back. He's stuck in that too because he doesn't believe in crypto, and it's antithetical to everything he came up to understand. So part of it is like Nouriel Roubini, where he just doesn't want to accept that this is where we are. And then you saw a year of really bad behavior, and all of the people that hated crypto, they hate it even more because they saw all of these idiots sitting on their couch trading government money for Doge. But you know what? Take away all the bad behavior, the GameStop, the Doge, the memes, and all that kind of stuff. And yes, it was all a bunch of idiots, completely stupid behavior. But that's 1 year of stupidity from the average Joe six-pack. Look at the years and years and decades of bad behavior by all these crony capitalists that sit next to the spigot. And as the Cantillon effect pushes out government money, misallocated, malappropriated funds for organizations that don't deserve it, companies getting bailouts that have failed. They should all be bankrupt. They should all go to zero, but they don't let them. If you don't let a bad company fail and those assets end up on the hands of another balance sheet with a competent fiduciary, that's not capitalism. People like capitalism, man. We don't have capitalism. Who knows what capitalism might look like? We have crony capitalism and short-term perverse incentivized politicians and quasi-central planners trying to manage outcomes that they don't even understand how to describe. So we have these systemic problems. So yeah, you saw bad behavior in crypto. You saw bad behavior in GameStop. You saw bad behavior in all these junk assets going against the man, right? Going against these guys that were shorting more stock than even exists. Of course, those guys got blown up. And so everybody goes, see how stupid crypto is, see the memes. But they've been doing it for years. I hate to use the whole they thing, but they've been doing it for years. So they're getting a taste of their own medicine. They just got it all at once. Is a lot of that behavior going to go away when people start having to go back to work and all this kind of stuff? Yeah, it's going to go away. And that's okay because people are going to have to go back to work. But 10 million of them won't be able to get back to work because there's no jobs. And then they're going to start discussing, why are there no jobs? And they're going to start discussing universal basic income. And then down the rabbit hole we go. So anyway, the end of all that circuitous thing, I'm not getting suckered into a meetup again. Those things are an absolute dumpster fire waste of time. I just can't. It's like going back to fourth grade, man. And you know, the thing that's kind of heartbreaking, I see all these guys doing deals and they're telling me about all these things they're doing. And I'm like, what's going on over at your company? Certainly you guys don't have money. No one funded your bad behavior, I hope. Or people that are like putting these things together and they don't have any idea what they're doing. And I'm not going to get any deeper into that, but I'm just like, oh my God, dear God, there's so many people out there that don't know, that don't have any idea what they're doing. And there are people behind them throwing money at them. It's the worst, but it is what it is. Okay, let me say hello to garbage crypto guy, Dowd Heister, Antonio, CC Brown, Biotech Breakout, Spirilla, Gordon Bennett, Ocean Dawn, Shootin, Belinda Cook, Get Involved, and Hootie. What's up? Let me say hello to Antonio again. Vincent Rouleau, Biotech Breakout, Tube Pipeline. Michael, what's going on, Michael? Pew, Bastille Day. Bonjour. Qu'est-ce que vous faites ici là pour le fête du Bastille Day? Candace, hello. Expat Matt, Scott Hill, Brady. Belinda on the other side, Scott. Adam, of course. What's going on? Let's see. Yeah, I know. Clubhouse is a dumpster fire. Only time I'll go on Clubhouse is if Antonio and Gino have a room. If Antonio and Gino have a room, I'll go in there. Otherwise, my name's Bennett and I ain't in it. Let's see. We got Darting Uphill. We've got BZ. What up, BZ? What you doing? What you doing? Dave and Ashley, good to see you. Ocean Dawn on the other side. Jerry, pura vida, Jerry. Sebastian, Lori, Crypto, 10x1. Todd, good to see you. Nesh, Frank, JR, Stock Jig, what's up? What that is story of the I know, right? So's in Denver, what up? Okay, so I think we've got everybody that's here right now. Cool. Throw a like on there so we can get, I'm not going to use any profanity today. So hopefully this video will stick because we're going to talk DeFi. And this is one that people may want to come back to. So we have some cognitive bias. We're going to talk about another cognitive bias because we do that every day. And if we do not know what these cognitive bias are, we are doomed to repeat them over and over and over and over. We don't want to do that because that creates systematic deviations in good, sound judgment. And we don't want to do that. We want to get paid. And the only way to get paid is be smarter than the people around you, right? You don't have to outrun the bear. You just have to outrun the fat kid. And in the crypto space, from what I know of last night, they're all fat kids. It's just a bunch of fat kids at a campfire waiting for a bear attack. And then you tying your shoes. So, yeah, we will be right back after these non-commercial break. LeBron James. All right. Best player ever. But no big deal. Best player ever. Okay. He's like, you shut your mouth. You shut your mouth about that. Best player ever. I'm not even a fan of his of the teams he's on. Best player ever. Let's be honest. Okay. Let's take a look at markets really quick. So we're going to go, I want to go markets, then DeFi, then we'll go to cognitive bias. How about that? If you have a question, put Q or question, and we'll try to get to it. If it's in the context, if it's kind of random and out there. Joe Fernandez, ¿qué onda? ¿Qué estás haciendo? Espero que todo está bien. Okay. So I want to make sure that the questions have some kind of continuity to the topic. And if it's just a one-off, I'll kind of knock it out really quickly. Okay. What do we got in the price world? Well, let's look at the Bitcoin. It dipped to the high 31s. I was trying to sell some puts, but the problem is at night, if prices change at night, a lot of the people aren't watching the market. And so there's not enough liquidity right now. There's not enough action on Ledger X to get those prices moving at night. I wish they had more exposure. They do not. So I couldn't really take advantage of it because that was almost $1,000 swing. And I wasn't seeing it in the puts. So I didn't get any sales off. I just kind of watched it like a tard all night. Anyway, it is what it is. So that being said, the Bitcoin is approaching 33,000. We are kind of range bound. My guess is people are kind of bated breath over the GBTC shares, the unlocking period. which I think is a bunch of nothing, because I don't think if you're sitting on a disc, I mean, if the premium is not cooked in, and you bought, 6 months ago, you bought right around here. If you were buying Bitcoin, especially if you were buying, even on the institutional level, you were buying Bitcoin, pushing it into GBTC. You got your 6-month unlock. So that puts us about, even if you were February. So that was when prices were going up. You're not going to sell Bitcoin you bought at 40 for 35 or 33. You're not going to sell GBTC that was pegged at 30. Let's say even with a premium pegged at 45 or 50. You're not going to sell that at a discounted, real or a discounted nominal of what, 30. So you're not going to take that kind of haircut unless you're tax harvesting. Everybody's not tax harvesting. So my guess is that this whole GBTC unlock is nothing. Like nothing. We'll see. Again, a little bit of tax harvesting maybe, but otherwise nothing. Because if you're at a discount, you'd wait till those shares traded at premium again. Okay. I'm not going to. There was something I was going to talk about with Bitcoin. There are some chart setups. Again, it's kind of, I don't know that I really buy into it, but what the charts look like is that Bitcoin could break to the high 30s. But again, not enough data. Okay, Ethereum is under 2,000. Again, it's a good place if you have ERC20 tokens or NFTs that you want to move around and do this and that's with. Now's when you do this and that, because the fees are at least substantively lower than they were when Ethereum was 4,300, Bitcoin was 64,850. Blah blah blah. Polkadot. Let me go Cardano. Polkadot. Cardano got down to $1.21 yesterday. Some of you took advantage of it. Good on you. Do I think this is the bottom? There's no bottom or top for these assets, but I think this is a relative bottom. And if you were holding off on adding more Cardano as you approach smart contract, as you approach Alonzo and the rollout of Goguen, it's probably not a bad place. Even if you're just watching Cardano and you could get an entry point around here, not bad. Also Polkadot, not bad. The top three, these are your three top racehorses. And then you probably throw in, if you have an Ethereum position, you probably sprinkle some Matic on top, because they look like the only one that's doing any meaningful kind of layer 2 scaling. We'll call it layer 1.5. It's not really a DApp structure. So yeah. Cool. Theta, I don't know. The staking did not look super great when I kind of dug into that, so I'm going to hold off. VeChain, I really don't know, because even the friendlies in China are no longer so friendly. I don't know. China is really decimating the entire crypto space, and to their detriment. I think they're going to look back and they're going to go, "Ooh, we went a little too far." They've pushed all the mining out of China, which was a huge tactical advantage that they had. They no longer have. That was a huge mistake. Let me say this again. We will look back. We will likely look back. There's no absolute statements in crypto, right? There's no absolutes in investing or even in life. I would say with a high degree of certainty that China will look back, and they will look back woefully, and they will say, we made a huge mistake when we forced out all of the Bitcoin miners. They're not ever coming back. China, if you're there, real quick, they're not ever coming back. What you just gave up was control over the first biggest original blockchain. You dummies. Now, they can say whatever they want. And China, and listen, China, it's a whole country of really intelligent individuals, but they're governed by a very, quixotic? A bunch of sketchy individuals that maybe aren't operating on the game theoretically. Let's just say that. So anyway, huge mistake. But what I don't want right now is I no longer want exposure to Chinese products. So VeChain at 7 cents, buy, sell, hold. You do not add. If you hold, you hold. You would add maybe I'm going to lower my ad to about the 3 to 4 cent range. I'm no longer adding at 5 cents. I would add around 3 to 4 cents. But this thing could grind all the way down to 1 or 2 pennies again. Very likely. I don't think there is use utility and real adoption of VeChain in any meaningful way. And I think that the cards are really stacked against you. Now, could there be that outlier event where they go, oh, VeChain's cool, the government loves it? Yeah, but remember, they just shut down a company that was working with the regulators in China. A company that was just set up to work with regulators got shut down by the Chinese government. So if their homies are getting shut down, what chance does VeChain really have? I don't know. Cosmos is cheap, but it's cheap for a reason. I think it's priced right. I would not add here. I would consider adding under $10. Engine. Oh yeah, I exited Engine. I'm out. My name's Bennett. I ain't in it. I think Engine has a future. I just think there's better ways to skin it, and I want to be at the protocol layer, and Engine is not a protocol. Engine is still kind of in that murky, almost dApp type place, but it's an NFT play, and if you're going deep in the NFT space, the problem for me is I have a lot of actual NFT artwork exposure, like a lot, like an amount that I probably should not mention on a live show. So I'm not going to add exposure to exposure to exposure. I'm not getting leverage on my leverage, so I'll be fine. Nexo. I added Nexo. I told you guys I added yesterday. I actually converted Engine to XR. So I went Engine to Bitcoin to Bitrue, on Bitrue, Bitcoin to XRP to Nexo. It took a long time to fill because it's incredibly illiquid. I pushed that over to Nexo to pop me back up to being a platinum man. Woo woo. Near. I like near under $2. I really like, and look at the market cap. Look at these sub $1 billion market cap assets. Any token can get $1 billion market cap with a little bit of Twitter action. Is this the world we live in? These things can be pumped even without TikTok. I know it's crazy. OGN, cool company. Not the greatest public outreach. If you really believe in this, anything under $1's probably a good deal. They have some cool staking stuff. I'm not in Origin because it still doesn't look juicy to me. It doesn't mean it won't go back to $2 or something. It just doesn't look juicy to me. Thomas, good to see you. Bill, good to see you. Hoop and Tony, good to see you. Good. I think I got everyone. Civic. Okay. Graph token, I like it. Probably I like it better around 50 cents. But I still like it. And they're doing a lot of cool stuff. It's just, again, they don't really communicate. Flow has a lot of money. They're not going anywhere. They have some real kind of big dog investors in it. NBA Top Shots is doing quite well. Rarible is launching platform exposure through Dapper Labs, so on the Flow blockchain. So that's coming at some point. Okay, Telcoin, I'm sitting in profit. I'm getting eroded a little bit, but again, it's all profits, house's money. So I'm just going to sit and let it ride. Is it going to change the world? Probably not. Rune, below $6, I'm a buyer. AR, below $10, I'm a buyer. 1 inch, yeah, I'm a buyer. I bought it $3. Would I add? Maybe. They're doing some really cool stuff, and it's still, in my opinion, it's the best swap platform. Audius doing pretty good. I mean, it's up 40% on the week, 10% on the day. Yesterday when we were talking about it was $1.22, 23, 24. No rants, S2K. Nice and quiet. Easiest money in my life. I found bugged BTC exchanger. I posted video. Yeah, my guess is if I think that you're trying to sell something, I'm gonna time you out because we're not selling anything. Nothing is being sold here. Don't sell anything. I'm going to sell something, sell some knowledge. All right. Fetch looks inexpensive to me. Render keeps melting up. I like it. I'm going to keep buying it. I'm going to dollar cost average into it and continue until $1. New kind of failure is up 4 cents, 4%. No one cares. This has been the worst trade I've made all year. It's on me. I trusted someone else. Don't ever do that. Do your own research. Matrix AI. Yeah, it's up 20% today. This coin it may be an AI coin. They claim to have a lot of partnerships. It was definitely a pump and dump. Definitely. I don't know what it is now. I have a tiny little bag. I don't know what it is. I can tell you that it's not Fetch, it's not AGIX, it's certainly not SDAO. I don't know what it is, but it is this. AGIX I like a lot, and SDAO I like a lot. There we go. There we go. Okay, price is done. Let's talk about some DeFi. And so what's a good background for some DeFi? I guess this is it should probably be Ethereum, right? Because everything seems to be on Ethereum. So let's just put the Ethereum. Let's just put the chart up. There we go. Okay, so let's talk some DeFi. Stock question. Stock Jig, you need to put the question. I can't guess it. I can't guess the question. So yeah, at some point he's going to have a question and I will give a shot at answering it. But until then, we are going to talk. Did he do it? Is there a question? Okay. How many of these marginal crypto projects are just gone as a result of this nominal correction? I don't know, but I think a lot. I think a lot of this was bad behavior over COVID. You know, you guys know how it is. The same people that were without a job, they were unemployed, maybe even before COVID. And then all of a sudden they changed their profile to say entrepreneur, day trader, portfolio manager. Jesus Christ, man. We're having coffee and this guy's like, so what do you think of Doge? I'm like, oh my God. I wanted to choke him and just kill him to put him out of his misery, but I didn't. Because I would be in prison. Okay. So, but I wanted to, and he's like, okay. And he's like nodding. Like I said, it's a junk coin with a bunch of junk people that invested in it. He's like, interesting. I go, what do you mean interesting? What are you nodding about? You tard? What are you nodding about? He's like, what about SafeMoon? I'm like, you're done. Get out of here. So there's this bunch of idiots. It's not completely their fault. There's not a lot of good data. There's not a lot of good information. I mean, unless you're willing to read. But who's going to read when you can just follow green candlesticks and people on TikTok, right? Why would you learn about these markets when you can just follow idiots on TikTok, dancing, synchronized dancing and moving there and doing all while they tell you what digital assets to buy? Oh man, we live in a really weird place. Okay, let's talk about the cryptos. So let's do a little DeFi chat, shall we? Okay, so and I'm going to post these things up here as we go, but I want to kind of go through the basics of the DeFi space. I found a cool article, and so I'm kind of cherry picking some things out of the article. But anyway, simply put, DeFi, shorthand for decentralized finance, is an ecosystem of blockchain-based applications that offer a range of financial services similar to those provided by banks, insurance brokers, other financial intermediaries. Okay, so DeFi is decentralized finance, decentralized financial products. And it means that we are removing the rent takers and the middlemen, and we're replacing them with software. I like the term middleware, right? Now, it's not completely middleware because in some of these very few of these decentralized financial platforms are actually truly decentralized. But that's the intention. That's the goal. Yeah, that was, yeah, that's funny. That's about what it was. But there's, you meet a couple of interesting people and then you realize why you don't ever go to meetups. Okay. So let's continue. So when you hear DeFi, these are just traditional financial product. This dude, man, post a video. Okay, I gotta let you go. Gotta let you go, brother. Bam, he's gone. Sorry, Thomas, you no longer exist. Okay, so when you're thinking of DeFi, you're taking the legacy financial system, we're transitioning it over to have decentralized solutions to very clunky, very inefficient, old school, paper-based, settlement-based, slow, difficult to manage, difficult to audit financial products, legacy to digital. And there's a lot of growing pains on the way there. It's not a smooth transition, but we got to see some chaos so that from the ashes of these failed projects, we'll see some of these things might actually make it work. So, the main difference with decentralized financial products and the traditional legacy financial products is decentralized applications, dApps, that run autonomously without any third party acting in the middle, right? So that's like our middleware instead of middlemen. Each dApp is powered by a smart contract, which is a special computer program that automatically performs some function when certain predefined conditions are met. So when you hear, oh, smart contracts, what is that? It's exactly what it sounds like. It's a little contract, an if-then statement or a series of if-then statements, right? A little program that automatically performs a function when certain predefined conditions are met. How do they get that information? Well, that's where oracles, these networks of oracles, inject pricing information, timing information, or just specific pieces of data that the smart contract might need. It might need information from the outside world. Oracles, hopefully trusted, inject that data into the smart contract so that it can either fire or not, right? So that's the kind of performance mechanism. All right. Crypto lending is one type of traditional financial service that is now accessible through peer-to-peer operated dApps, right? We're seeing all sorts of peer-to-peer lending. Similar to depositing funds in savings accounts to receive interest payments, crypto investors can now lock up their funds, use them to provide liquidity. So, right, liquidity pools, right? You can be a liquidity provider, okay? You can stake. You can simply place funds on a platform like a Nexo or Celsius or whatever, and they will lend those funds out and they cut you in on a piece of it. Essentially, you're a partner to the bank. You become a lender to profligate borrowers. And so crypto investors can now lock up their funds in a variety of ways to provide liquidity, loans, etc., across a range of decentralized platforms to receive regular interest payments. This is not to be directly confused with staking. Staking is a little bit different. It's providing support to these platforms, mostly smart contract-based protocol layer assets to assist in the consensus mechanism. Does that make sense? In those resources we talked about last week, we talked about what is all of crypto, how does it function? Find a block, propagate the block, validate the block. That is all of crypto. If you know those 9 words, you understand how decentralized products work at the very core, right? How does a transaction go from being keyed in to being propagated out and validated on the network? Determine what the block is, send the block out, validate the block. Woo-woo, crypto. All right. Many of the interest rates offered on these dApps, decentralized apps, are significantly greater than anything currently available in the traditional financial space for now, making it highly attractive, a highly attractive passive income generating stream for crypto holders. But before lending any assets, there are a number of associated risks. Oh, yes. There are so many risks. So again, just to reiterate, DeFi dApps are powered by a smart contract, special computer program that automatically performs a function when certain predefined conditions are met. They use oracles to inject that data. Okay, let's talk about the ways you can get punished in DeFi. And there are a few, and you hear them a lot. And so I want to make sure that when you guys are talking about these to yourselves inside your own brain box or to other people, that you are spreading the right information and that you yourself understand how these things can get hammered. We all know about the rug pull It's a bunch of developers that leave backdoors, and then a few days or weeks or month after launching and providing a bunch of liquidity, they go and flood the market. They suck their cash units out and off they go, and they just laugh at you. That's a rug pull. We'll talk about that. We kind of understand what flash loan attacks are. We're going to talk about that. We're going to talk about impermanent loss. Okay. And I'm going to put some statistics up. Impermanent loss. Say, when you commit your assets to a liquidity pool, you risk something known as impermanent loss. And this is essentially, it's impermanent because it's a value rebalancing loss. So let's explain it. Impermanent loss is when the price of assets locked in a liquidity pool changes after being deposited, and it creates an unrealized loss in dollar terms, right? Because you haven't realized the loss until you sell the asset. Otherwise, it's just that the value of your units is less than it was. Okay. So it's an unrealized loss. It creates an unrealized loss versus the liquidity versus if the liquidity provider had simply held the asset in a crypto wallet. So as an example, I have USDT and Ether. I can hold them in my wallet, or I can plant them on Nexo and grab a little yield. Okay. There's a variety of places you could put it. I could lock it up in the ETH2 contract, and maybe I get it back at some point, but I could put it in a private wallet, or I could put it on Ledger Nano X, and I have those assets. Now, those might change in value in currency units, but I still have my 10 Ethereum and my 20,000 USDT, let's just say. Let's keep it simple. 1 Ethereum and 2,000 USDT, okay? So, and I'm going to explain liquidity pools because a lot of people, I think that they go, oh, what do I do? Like, how do I? So we'll get to that, and so that you guys understand what some of the risks are. What you see in front of you, these are what the price change is and what the loss equates to. And so I'm going to go through this in a second, but essentially, as there is a change in the balance of an asset in a liquidity pool, because in liquidity pools, there are two assets, an asset A and an asset B. That's the pool, right? And markets trust that people will come in and arbitrage the price variances to keep the pools liquid. And that's a balancing act, and that doesn't always work out. So we will go into that, but essentially, we'll get there. Okay. So here's the deal. DeFi pools maintain a ratio of assets in a pool. Okay. So, let's just think right now for liquidity pools. Let's think Ethereum, and they use Ethereum Link in their example. So I guess that's a good example. I just think Link is stupid. But for example, an Ethereum Link pool might fix the ratio of Ether and Link tokens in the pool to 1 to 50, respectively. So in our example, we used Ethereum and USDT, right? So you might have 1 Ethereum, 2,000. 1 Ethereum is 2,000 USDT. Okay. So you would put in one or the other or both, and you would then be a liquidity provider, right? So let's say we put in our Ethereum and our 2,000 USDT, meaning anyone wishing to provide liquidity would deposit both Ether and USDT into the pool in that ratio. And then sometimes you say, well, I only have one asset. Well, what they'll do is they'll take that one asset and they'll cut it in half and convert it to the second asset in the pool, and then they'll spread your bet, right? Half and half. You're a liquidity provider at this point. DeFi pools rely on arbitrage traders. And remember, we talked about arbitrage a lot, where you look for slight differences in the price of something where you can sell the high one, buy the low one, and collect the spread. All of life is arbitrage, okay? So DeFi liquidity pools, they rely on arbitrage traders, which many of them are bots that look for these opportunities. And they want them to come in and align pool asset prices with the current market value. So if, for example, the price of Ethereum is 2,000, but the value in the Ethereum USDT pool is, say, $1,950, there's a difference there between the market price and the Ethereum USDT pool. right? So arbitrage traders or bots will come in, they'll see that discrepancy, and they will be incentivized to add Ethereum to the pool to remove to add Ethereum or the other asset to remove the discounted Ethereum. Does that make sense? So if they see one asset trading at a discount, they'll go in and add the other asset to bring it back to par. Okay, so when arbitrage traders or bots flood these pools with tokens in order to remove the discounted token to grab the arbitrage, so you would add the more expensive one, you would add it, and that starts to balance it back out. The ratio of coins changes. So in order to regain balance, the pool has to automatically increase the price of the token in higher supply, right? And listen, don't overwhelm yourself with, I'm not trying to teach you to go out and game the system. You're not going to beat the robots. But just understand this is what's happening all the time in these liquidity pools. And these pools count on traders and bots to come in and do this. Okay, so this is very normal. All right. So it's encouraging arbitrage trading practices to maintain these liquidity balances. Okay, once the pool rebalances, the rise in the value of the liquidity pool is often less than the value of assets if held by the lending protocol itself. So when these pools readjust and rebalance because of arbitrage, sometimes you'll have more on this side and less on this side, or more on this side and less on this side, meaning one of the assets you will have lost some value, right? It's an impermanent loss. You haven't sold it yet, okay? So anyway, impermanent loss happens when the price of the assets in the pool change and then become rebalanced. Does that make sense? Because you can have the quantity be balanced, but the price be disproportionate. Or you can have the price be balanced and the quantity is disproportionate. This is always happening in real time. Cool, you get it. So the chart I give you right here gives you an idea of the relationship between the price change and the percentage loss. So a 1.25x price change results in a little over 0.5% loss. A 1.5% price change is a 2% loss. It doesn't start getting crazy until you get to 2x. So 1.75% is a 3.8% loss, not so bad. A 2x price change on one of the assets is a 5.7% loss. A 3x price change is a 13.5% loss. 4x is a 20% loss. 5x is a 25% loss, right? And again, these are impermanent losses because you could hold the asset and the prices could come back up or rebalance or whatever. But it's always rebalancing, meaning the number of tokens on one or the other side of this equation is changing in real time. See, you just have to understand that when you're providing liquidity, your tokens are now part of the potential for impermanent loss. And those are the risks associated with liquidity pools, and they usually shower you with their made-up governance tokens as a way to incentivize your behavior. Great. And sometimes fees and stuff like that. Okay. In defense of these protocols, liquidity providers, LPs, that's people, us, that are putting our currency units in there, our tokens, are rewarded with a proportionate amount of trading fees for adding assets to the pool, which can often offset these impermanent losses. Uniswap, for example, charges a flat trading fee of 30 basis points, which is distributed to the liquidity providers. So to the investors, you guys. All right. The best way to mitigate impermanent loss is to provide liquidity to pools containing less volatile assets, such as stable coins. Now, that's one way to kind of mitigate these losses. The problem is they'll go find an exchange. They will. And this is similar to kind of what happens with flash loans. You can find exchanges that trade some of these assets that are less liquid. By buying or selling of the asset, you can reprice that asset. When the price makes its way around, through the Oracle networks, and they see, oh, wait, this asset's really cheap over here, or you drop the price of an asset on some small exchange, you snatch it up, you use it to collateralize a loan that you got on a more liquid exchange because you got the other asset cheaper. All I'm saying is, and you don't have to know all this, you just have to understand it's not impossible to game this system. It's actually not very difficult to game the system. And if you have a little bit of money, you can game it all day long. And guess what? It's not illegal. So when you hear people, oh, a rug pull is illegal, that's absolute theft. But these flash loan attacks and things like that, there's no theft involved. They're exploiting junior, unaudited code, bad game theory. They're exploiting that in real time, usually in less than a second. Boom, done. And so we want to talk about that. We want to talk about flash loan attacks. This is important. So impermanent loss shouldn't be something that scares you away from DeFi, just as a general rule, but rather it's a calculated risk that you want to understand before lending into a liquidity pool. So treat it for the risk that is associated with it. Okay, let's talk flash loan attacks. So part of understanding flash loan attacks is understanding the difference between secured and unsecured loans. Okay, so flash loans are a type of uncollateralized lending unique to the DeFi space. In the traditional centralized model of banking, there are basically two loans. So you go to Chase and you can have an unsecured loan or a secured loan. An unsecured loan requires no collateral because it's typically small amounts of money. So think like a few $1,000s, right? Like a credit card, something like that. Unsecured. Here you go. Here's a credit card. Great. Swipe, done. Then you have secured loans. Secured loans are larger, require collateral like property, car, investment, etc. And throughout the entire loan process, banks will have tools to access the credibility of clients, credit scores, reports, how many times you've been evicted, like all this kind of stuff, right? These are secured loans. These are bigger loans, commercial loans, things like that. Okay. Flash loans are a type of unsecured loan. And the way they work is they use smart contracts to mitigate all of the risks associated with traditional banking and all the kind of checks and balances. So the cool thing about a flash loan is it starts and stops instantly. And throughout a flash loan, there might be tons of different things that are happening, but if it's an all or nothing transaction, meaning everything happens according to plan or the transaction unwinds instantly. So there's really no risk for the lenders because they know that, well, if this flash loan doesn't work, nothing happens. It reverts, it rolls the tape back. And if it does work, fine, we got our fees. So the concept is like this. A borrower can receive hundreds of thousands of dollars, even millions of dollars in crypto assets without putting up any collateral. The catch is they have to pay the full amount back within the same transaction. There's usually a few seconds. 1, 2, done. Okay, that's a flash loan. Think of it like a flash. Bang, by the time you see it, it's over with. Either money was made or it wasn't. It's that simple. If the loan isn't paid back, the lender can simply roll back the transaction like it never happened because that's how a flash loan works. It's all or nothing. It works or it didn't. And this is kind of interesting to understand. When you hear, oh, a company got flash attacked, didn't really get attacked. It got exploited. There's nothing illegal about a flash loan. If someone is smarter than you on the other side of the transaction, they beat you. That's it. Okay. So, again, if a flash loan isn't paid back, the lender gets to roll back the transaction, meaning the loan never happened. Okay. So because there's zero risk involved in issuing these type of loans, there's no limit to the amount a person can borrow. And because the entire process is decentralized, there is no credit scoring. Well, at least not yet. Well, that in the future, we don't know. But right now, there's no credit scoring process. There's no reports preventing anybody from qualifying for a flash loan. You can be a flash loan. You can do a flash loan. You can do a flash loan. Okay. So flash loan attacks are when, they say bad actors. I don't know if it's bad actors or just people exploiting weakness in code. If you're an amateur engineer and you're building these products, expect that you're going to get pilfered. Expect that smarter people are going to take advantage of you because they are. And if you have in or unaudited code and you get hit, you blew it. That's on you. That's not on them. Anyway, flash loan attacks are considered attacks when bad actors borrow huge sums of money using these special types of loans and use them to manipulate the market or exploit vulnerable DeFi protocols for their own personal gain. They make that sound bad. Listen, these people that start these DeFi protocols, do you think they do it for you, for the investor? They don't give a crap about you. They're doing it for themselves. They don't care about you, bro. So why should you care about them? You shouldn't. So I'm not against people that do flash loans. Hey, if you're smarter than the guys that wrote the code, you deserve to win. They deserve to lose. So there's two people make a trade, bro. All right. A recent flash loan attack against yield farming aggregator Pancake Bunny made headlines when attackers caused the price of Pancake Bunny's token Bunny to drop 95%. Reminds me of Iron Finance, right? Our favorite 502 gateway error, Mark Cuban. Anyway, so they'll reprice the collateral token, or they'll reprice one of the tokens associated with it. So they did this by borrowing large amounts of BNB. There's a surprise, right? Binance Chain through Pancake Swap lending protocol, manipulating the price of Bunny in off-market lending pools, right? Find small pools that are relatively illiquid, manipulate the price, and then grabbing a bunch of Bunny, dumping the Bunny on the open market, causing the price to crash. When the price crashed, they paid off their loan. Bang. That's not an attack. It's an exploit. And it's an exploit on a scammy project, which was Pancake Bunny. All of these, come on, man. Don't be stupid. Don't be, just say the name of the platform. Say the name of the protocol. And if you giggle, step away from the computer. As is the case with almost all flash loan attacks, the thieves, they're not thieves. The smarter people escaped without repercussions. It's estimated the attackers netted nearly $3 million in total, as they should. If you put money into Bunny or Pancake or Sushi, you deserve to lose every penny. You are a dummy. Period. There is no justification or rationalization. You don't get to wind the clock back because you're a gambler. You lost. It is what it is. So once the liquidity pool is drained of a particular token, liquidity providers can become exposed to this impermanent loss that we talked about earlier. Not to mention lesser known tokens hit by these attacks, such as Bunny, the Iron Finance token, whatever the F that was called. It causes investors to lose confidence in the projects, and they rarely recover in price. Good. This is a way to expose bad projects. Isn't it weird that they're all on Binance? Isn't that funny? Last one. Let's talk about rug pools. Okay, so you know what the flash loan is. Boom, you lost. Great. Rug pools are a new type of exit scam where DeFi developers create a new token, pair it to a leading cryptocurrency such as Tether, USDC, one of these other stable coins, or Ether, set up a liquidity pool. They have a little back door. They flood their token in there. So you hear about the rug. Oh, it's another rug pool on Binance. It's another Binance rug pool. Why? Well, they made it incredibly easy. Some say they made it so easy that it seems likely that they're even a part of it. I don't know about that. But CZ is a dirtbag. And it's like, how far does the dirtbag go? Another guy I'm very uncomfortable with is this Sam Bankman-Friedman guy, the FTX guy, who just shows up out of nowhere with hundreds of millions of dollars. He's a billionaire all of a sudden, and he just starts sponsoring things, buying sponsorship deals, Major League, you're like, well, but your exchange is not even a top 10 exchange, bro. So where's the money coming from? My guess is we will find out it's a rather large facilitator for money laundering. That's my guess. We'll see. Anyway, without traditional forms of regulation in the DeFi space, users have to develop a certain degree of trust with these platforms that they're willing to lend to, like willing to lend your assets or buy tokens from. Unfortunately, the trust is breached in the form of these rug pulls. So they market these newly created tokens. They encourage a bunch of people to get in. They're going to give them tons of this high yield governance tokens. Woo woo. Once the pool has a bunch of some actual cryptocurrency in it, the DeFi developers then use these backdoors that they've intentionally coded into the token smart contract to mint millions of new tokens that they then sell for the popular currency in the other half of the liquidity pool. This is one way they can do it. So this drains the cryptocurrency from the pool and leaves millions of worthless coins that they printed up out of thin air in its place. Then the founders disappear. That's criminal, right? So, and that's why every single country basically on earth is telling Binance, you guys are finished. It's one thing. Listen, Binance is the Bill Cosby of crypto, right? When a couple women came out, you're like, not Bill Cosby. I don't know, man. When 80 women came out, you're like, okay, like enough is enough. Get those pills out of his pocket. You know they're Rehibinol. Anyway, a famed billion-dollar rug pull came in 2020 when Sushi Swap developer Chef Nomi unexpectedly liquidated his sushi tokens after raising over $1 billion in collateral. The price of the Uniswap competitor's token fell to nearly zero in what is remembered as one of the most dramatic moments in all of DeFi. Yeah, so this kind of fraud actually vastly exceeds any hacks and thefts. The rug pulls is the new theft because it's easy for these developers. And a bunch of idiot rubes keep buying this junk. So you get what you get. DeFi fraud is a billion-dollar industry, and despite efforts to mitigate risks by developers, it remains a prevalent aspect of the growing space. During the second half of 2020, it was reported DeFi-related rug pulls and exit scams accounted for 99% of all blockchain-based fraud. So if you're a politician, that's what you should be talking about, not child stuff and slavery and weapons transactions. That's all done with the US dollar, bro. But the rug pulls, that's a B&B quandary. How to avoid DeFi threats. Despite the rampant increase in this type of malicious activity, there are methods to vet a company for potential exit scams before investing. These include verifying the team's credibility on other projects. Look and see what they've done before. Read the white papers. See if they're written by like the kind of people that wrote Flare that have a 6th grade education, or like the people that created Cardano, where you have hundreds of peer-reviewed, over 100 peer-reviewed papers by the scientific community, universities. That is a slight difference, right? Okay. Read through a white paper if you're going to own an asset. Dear God, man, know how the project works. This common sense 101, right? Everybody here should have already read the Bitcoin white paper. If you didn't, you are wrong. Okay. Check to see if the project's code has been audited by a third party. Do not involve yourself in projects with unaudited code. Period. Full stop. It doesn't matter what they're promising you. They have another motive. Why? Because you should go out, if you're launching a multi-million-dollar project, go get your freaking code audited, you hucksters. Also, be acutely aware of red flags like unrealistic projected returns, overspending on Twitter promotion and marketing, Link Marines. So just be careful, right? Ultimately, the same permissionless designs that make DeFi protocols vulnerable to theft are its source of potential to disrupt the financial industry. Yields are going to come down in crypto because bigger markets will come and arbitrage those opportunities away. But from these bad projects, we're going to see the fundamentals, the foundations of future good projects. So on the aggregate, while I'm not investing in DeFi stuff, I'm experimenting in one pool, which is a fetch-based pool, because I want to see how these autonomous economic agents act and react. I like the idea of a AI-based liquidity pool balancing, rebalancing against said impermanent loss. But other than that, I don't recommend the DeFi space to anyone unless you realize that you are gambling. As long as you're okay with that, as long as you know with certainty that you are a gambler, you look in the mirror and you say, that guy is a gambler. Okay, cool. Cool, man. Okay, let's switch gears. Let's talk halo effect, my fine feathered friends. Okay, and I won't take too long on this one, but what I will do is I'll put it up there so you can read it. let me stop screen share. Let me share my halo effect with you. Bam. Boom. Okay. Halo effect. Can you guys read that? Oh, we had to make it bigger, didn't we? Yes. We're making it bigger for everyone involved. Okay. The halo effect, the tendency for a person's positive or negative traits to spill over from one personality area to another in others' perceptions of them. Whether it's physical attractiveness, right? We trust the pretty girl more than we trust the gross one. I guess I shouldn't say that because I've just disenfranchised all the gross girls. There's gross guys too. Matter of fact, most guys are gross. So don't get your undergarments in a bind. Okay. Whether it's physical attractiveness, height, expertise in a particular field, deep friendship, whatever. This also works in the negative, meaning that we may overly criticize somebody we don't agree with, or like-based factors that are unrelated to their current actions or decisions. Like you see two politicians, you see the tall, dapper, good-looking guy, the Bill Clinton, and then you see the other guy that might not be as debonair. And you say, oh, that guy's he's kind of a squirmy little fella. I don't really trust him. But Mr. Clinton, look at that guy. He'd never steal from you. That guy's, no. Don't get the halo effect. Okay. Example, authors of a biography they've written tend to praise someone too much and are susceptible to this form of a bias, right? You're spending time with a person, you're going to write their biography, and you spend time with them and you get to know them and you start to kind of like them and you start to empathize with them and sympathize with them. And pretty soon you're writing a different kind of biography. In a similar way, we view the negative actions of the people that we like in a much kinder way than those of people we don't like. Our judgment is biased by how much we like or dislike people. The pretty girl can do no wrong. You guys get it, right? So I don't know when I wrote this, but look, we can mostly agree that Trump is a kind of an idiot. I think we all agree that he's kind of an idiot, right? You may like him, you may not, but he's not the smartest guy. He's not the sharpest tool in the shed, more like a bowling ball. Anyway, I don't think he's evil. He's just not your typical politician. Okay. Now, full disclosure, I don't have a horse in this race. I'm not a fan of Biden. I'm not a fan of any of these guys because central planners are kind of douchebags, whatever. But I'm not saying that just because I don't like a person, I'm very careful not to think that everything they do is moronic, right? So you don't have to like someone to recognize that not everything they do is awful. Certain things might be awful. Certain things you might not agree with, right? Anyway, so it doesn't mean that everything Trump does is moronic. As I say this, he's probably tweeting his dick size or something similarly stupid. Or no, he won't be tweeting it, will he? Because he got deplatformed. But anyway, the point is, it's easy to let out our negative feelings and let them overshadow the current information so that everything a person does is interpreted as negative, right? I'm sure even Donald himself has done something at some point smart, right? Maybe at some point. I don't know. He's got a lot of money. He got a bunch of companies to give him loans that they should have never given him. So kudos to him, right? He won the loan battle, I guess. Deutsche Bank continues to extend him loans. Anyway, how do we overshadow the halo effect bias? It starts with good old-fashioned research and our constant reliance on the facts. Don't trust Warren Buffett because he's a genius. Don't trust Charlie Munger because he's a genius, although they both are in their own way. Don't trust Mike Green because he's smart on some stuff. Don't trust me because I say a few things that you like. Assume everybody's out to get you. Everybody's trying to pull a scam. Then you'll never be surprised, right? Trust people enough to research their theories on why things do or don't work. And in the case of Warren Buffett, he's a genius investor, but he missed technology. So you wouldn't listen to him for technology advice. You might listen to him for value investing advice. Okay. So it's not, you'll see that he's either wrong. Technically, I put the word retarded. I don't think we can say that anymore. Anyway, just said it. Or decidedly corrupt or morally corrupt and spinning up misinformation. So the problem is, I think it's safe to assume that everybody's trying to pull a scam and trying to steal from you. If you go with that assumption, don't be like, oh, I don't like you, or you're mean, or just be like, okay, cool. Let me listen to why they don't like Bitcoin, why they don't like crypto, why they don't like the assets that I like. I'm going to listen to that, and I'm going to go research it as if I'm trying to figure out if he's right or if I'm right, or if the answer lies somewhere in the middle. Okay. So anyway, I digress. Don't fall victim to the halo effect. Because someone is pretty, because they are tall, because they are good looking, or have cool suits, or badass Gucci shoes with Mickey Mouses on them. Don't let that shade or color the information. Do your own research. Assume that everyone's out to get you. Okay. Do I assume money in Nexo to be gambling on the DeFi space? No, it's not a liquidity pool. I'm gambling on platform risk, but I'm not gambling on the DeFi space because Nexo, it would be the thinnest form as a lender of DeFi. It's not a liquidity pool. It's not susceptible to flash loan attacks in other than just a repricing of assets, but you're not lending into pools. You're not participating as an LP, things like that. They are taking your money and lending it with some amount of insurance and over collateralization to probably mostly profligate borrowers. And so on the other side of that trade, there is some platform, there's some risk. But you would assume that the entire space is not going to unwind all at the same time. And if it does, you got bigger problems. Okay, cool. I think that pretty much does it. Let me stop this one. Let me go back to our beautiful screen with prices, and we will finish out the day. Everyone stay in school, especially in crypto school, and don't do anything my poor insolvent drunk, strung out on meth, high as a kite, smoking angel dust, just plumb full of pills grandmother wouldn't do. And, she looks like a sugar cookie again. She's got that just all over her face, that kind of angel dust. I guess, I don't know if it's angel dust and PCP, because I know she was hitting that, smoking that water earlier, but grandma, right? Freaking grandma. We'll see you next week.
Hey, this is the Prophet with Nick Black. It's time to chit chat. You know nothing about blockchain. We here to fix that. You want the news on them new stocks? This where you get that. So go and grab you a nice chair. It's time to sit back and talk to Prophet. Hey, you talking to the Prophet? Hey. We talking condos and nice clothes and driving Lambos. I remember them night codes, we couldn't stand those. We tried to drive on them house roads, but had to stay low. Now there's solutions to hard bills we couldn't pay for. I talked to Profit to get some profit, we couldn't change the top. If it's a stock and I need a cop it, I wait for him to drop it. Ain't no option, let's get it poppin'. We chillin' in the trap. I need some crypto, put it in my pocket by any means I rock. This is the Profit with Nick Black. It's time to chit chat. You know nothing about blockchain, we here to fix that. You want the news on them new stocks? This where you get that. So go and grab you a nice chair. It's time to sit back and talk to Prophet. Hey, you talking to the Prophet? Hey, you talking to the Prophet?
It's all fake news. It's phony stuff. It didn't happen.